So now the pressure has mounted further in Europe, and we want to talk about the Europe, but obviously the UK and some of the things that are happening within those entities. So just providing that highlight of Eurozone aggregate. So manufacturing was expected at 48.8, came in at 48.5. Services was expected at 49.1, came in at 48.9. So again, the composite in general is still contractionary. And now moving closer to 48, which is a real number. I mean, you're starting to see that pressure come through. Money supply still growing year on year, but that's being squashed very quickly when we look at the ECB. And then economic confidence dropped to 93.7, industrial confidence the same. So you're seeing that slowdown, but the bigger issue is, again, activity is waning. And that's something that is only going to accelerate when you look at the pain points that we've highlighted, especially on the inflation front, which accelerated again when we talk about Germany and some other areas next week as the data comes out. So the Eurozone manufacturing PMI and then the PMI orders minus inventories is showing that we're still not even close to the bottom of that move in PMI. So the deep Eurozone recession is coming. So here, when you look at it, forecast annual average real GDP growth is at negative 2.4% in 2023 with peak to trough drop of negative 4%. It's just we expect that to be worse. Again, we think that the depth of this is only going to accelerate, especially when you look at what is happening with Russia, now with the step up in Nord Stream, as we talked about in this special segment. Today's flash manufacturing PMI data for September will continue to kind of bear this out, which it continues to get worse. So now we'll get back to the Europe again, but the EU again, but we want to talk about the UK at this point. So the UK has always run trade deficits, but the war in Ukraine has stretched things to a breaking point. So the trade deficit grew to British pound $10 billion per month on average from January to July of 22 versus the average of $2 billion. So this creates a big external financing need, which is a drag on the pound. So now you see the pound finally breaking as the gilt goes higher. And this is all a mixture of right after the tax cuts, but now you had this insolvency as the need for external financing goes up. So you're issuing more and more debt, especially because trade deficits are down. Now you have the biggest tax cuts since 72, which is creating this huge deficit that needs to be closed. And that was when you saw people dumping the bonds to try to, again, account for this. So when you look at the decomposing recent moves in US, Euro, and UK curves, you get an idea of just how huge this shift was in the terminal central bank rates for the UK. So when you look at this, so the Bank of England had to step in to buy long-dated bonds. The 30-year tumbled by 100 basis points after the BOE support, and the BOE to buy up to 5 billion pounds of gilts a day until October 14th. But it ends. The gilt sales due to start next week was postponed, but they have to do, because again, the sales was supposed to be because they're still trying to tighten their entities, their balance sheet. The BOE still aims to reduce QE holdings by 80 billion. The terminal rate, maximum expected rate in this cycle, surged after the budget announcement. So again, the budget announcement happened, the tax cut happened, you had this massive shift, and the Bank of England had to step in. But it's only temporary. Their balance sheet is massive, obviously not to the level of Japan, the US, or ECB, but it's still massive in scale in terms of in those ratios. So that's going to have to come out, which is going to put pressure on the pound and is going to put pressure on the gilt. And that's, again, another huge problem. Impact of tax changes by equivalent household income. They scrapped 45% rate of income tax for earnings above £150,000, reduced basic rate of income tax to 19% from 20%, reversed 1.25 points increase in NICS rates. And again, you're seeing just the amount of just how this shifts, what that means for these entities and how that's going to move. And again, these huge shifts, it just creates more volatility, more instability. And that's not going away anytime soon. It's only going to get worse as the volatility picks up and as central banks have the inability to stay involved. They can just step in, but they have to quickly step out until they right-size their balance sheet, which is why we've been saying since we wrote the articles and since we launched this podcast and whatnot, since 2020, these are the problems where they waited too long and now they didn't preserve their bullets for the next round. Now they have to face, again, what is coming and the pressure that is happening. UK manufacturing PMI, new export orders came in at 41.5. UK manufacturing input prices, inflation is going up in Europe. Again, the input prices back up as new export orders back down. And it's, again, they're contracting at 41.5. So it just means that the trade deficit's getting worse as input prices continue to move up. We don't see that getting any better for LNG, electricity, natural gas, imports in terms of fertilizers and everything else, which again is going to keep the UK pinned down. Increase in 10-year government bond yields. You can get an idea of just where the shifts have been around the world, and the UK had that massive move. And that blew out the credit default swaps to such a level, which is why the BOE had to step in, bring things under control. But we know that there's an expiration date. And the market is just going to press because the moment the BOE steps away again, it's all going to continue once to that level, which again is going to keep pressure on the underlying economy. So then when you look at German CPI, all items coming in at 1.9%. And then year on year is at 10%. And as you can see, it's the highest it has ever been. Record high German producer prices continue to drive up consumer prices. As we've been talking about, PPI is a leading indicator for CPI, but just look at the disconnect. Look how insane that PPI is and shows you just where this is going and how much pressure remains to the upside, which is why there's so much pressure and so many issues that are going to continue in Europe. They're not going away. And losing Nord Stream, again, not to say that they were moving natural gas, because it wasn't, but it just takes away. If things get worse, there is no way, there is no going back using those pipelines. It would have to come from somewhere else. Now, new German manufacturing PMI new orders now below 40, coming at 39.7. So again, way more stress coming in. New export orders coming in at 40.8. And remember, Germany is an exporting nation. All of this is showing that there is way more pressure coming on the back of their economy, on the back of their GDP, which is why we do think GDP expectations are still elevated for the end of going into the end of 2022, as well as what 2023 is shaping up to be. Business climate collapsed, expected at 87, came in at 84.3. Expectations collapsed as well, expected to be at 79, came in at 75.2. So again, people are starting to express their issues within Germany. So then when you look at the manufacturing, here you can see that the manufacturing expectations getting hit. Essentially, expectations are going back through the floor. They're either at where they were at the beginning of COVID, or at least approaching it, especially on the construction side. And as everything else continues to take that out, we'll see more and more pressure across the German front. The Italian election, the right-wing coalition led by Giorgia Meloni, set to win a clear majority in Italy's 2022 general elections. Meloni will become the country's first woman prime minister and will lead its most far-right government since World War II. So you're getting an idea of just the pressure that remains, and look at the ballooning debt. And this is the issue with the anti-fragmentation tool, because Germany, if you look at the debt size, is at about, let's call it 73%, where Italy is at over 150%. So what the ECB has been doing is selling German debt and buying Italian debt, doing anti-fragmentation, trying to keep that balance between those rates. But you're essentially doing QT to Germany and QE to Italy, and you're essentially supporting this blind spending, which again needs to be addressed. But as you're starting to see, people are disgusted with the current political situation, and they're voting as such, with seeing more and more extremes coming in, which is something to watch as we look at this ballooning debt and how the ECB is going to manage it, with Italy being so elevated versus the Eurozone average and obviously the German average. Which is why when you look at the Italy-German 10-year government bond spread, even with them stepping in, it's still moving higher, because as an investor, why wouldn't you short Italy? At some point, the ECB is going to step aside and you're going to get a huge true up, which is going to push Italian yields much higher. All the while, the energy trade balance only gets worse, which is going to keep PPI higher, going to keep CPI higher, and going to pressure not only the companies, but also the consumer across the underlying markets. And then France was no different, with consumer confidence expected at 80, coming at 79, lowest level since 2014. And then the consumer confidence in Germany, expected at 39, came in at 42.5, well below anything, essentially double where it was at the lowest in terms of COVID. When COVID hit, it was at about negative 22. Now it's at negative 42, to give you an idea of just the amount of pressure that people are seeing and carrying through. Goods and services exports are set to fall even further. So when you look at the EZ firm's view of their competitiveness outside EU is coming down based on the leading indicators, which is why exports are going to get absolutely annihilated in Q3 and Q4. And that's when you start looking at the different pieces. So looking at the euro, looking at the pressure as the dollar goes up, we expect the euro to continue to fall, getting to about 85. That will help exports to a degree, but again, you still are losing total buyers. So the pool is shrinking, even though it may become more affordable. That pool shrinking is going to be the bigger overhang. So that's what we have for you on Europe. In the next segment, we're going to go into China, Asia in general, and some of those underlying pieces.